We are back with another Weekend Wisdom. Today, we're going to talk about year-end tax and retirement planning. There are some changes because of the CARES Act, so sit back, grab that cup of coffee, let's get started. Hello, this is Michael Loftus with Wealth and Wisdom TV, where education is the key to a successful financial future. First up, if this is your first time here, we are a practicing advisory firm. We do regular market updates, educational videos like you're seeing today, and a new series called Straight Talk. So if you're looking for a different opinion, that of Wall Street and Big TV, please do consider subscribing and hitting that like button. So, year end 2020. Thank goodness, right? This year can't go away quick enough, right? It has been an odd one, to say the least. Now, with that being said, we've got some changes when it comes to year-end planning. So let's go over to my iPad and go through some of these changes. First up, retirement accounts. As always, you want to make sure that you fund those retirement plans first. What do I mean by that? 401ks, 457s, 403bs, simple SEPs, right? Anything work-related, you want to take care of that first. Once you've maximized that, look to IRAs and or Roths. Now, the decision there is a tax question you should ask your tax professional about, but it depends on how much money you make, is it deductible, etc. So see what makes most sense for you. The next thing, of course, is your HSA, Health Savings Account. Most of us have high deductible plans today, so that's a good option as well. Next up, beneficiary review. No doubt, this is a great time to review everything, see if there's been any changes, add folks, remove folks for whatever reason. We go through this in our January meeting, so highly recommend this. Next up, as it pertains to retirement accounts, IRAs, and required minimum distribution, RMD, okay? What does that mean? Well, in 2020, you are exempt from taking that payment. So if you didn't know this, okay, you can put it back as long as it's not over 60 days old. So look at that as an option for you. But the big change is we've moved to age 72 to have required minimum distribution. Hold on, but if you reached age 70 and a half in 2019, prior to the rule, you were still responsible for taking that RMD, that withdrawal from your retirement account, okay? Now, going forward, 72. So if you're 71 and a half, we generally recommend take it that time and then the next year. So if you turn 70 and a half, take one next year and the year after. Otherwise, you'll take two at once. That can be a bit of a tax hit, so you want to think about that as you go forward. The other thing is they did not take away charitable contributions for your IRA. You must be over 70 and a half to be able to do that, but let's make sure you can still take advantage of that and take care of those charities that are in need today. The next thing is about retirement plans, IRAs. If you had a hardship situation, you are able to take money from the account without that 10% penalty if you're pre-59 and a half, okay? And they don't take out the mandatory tax. So in this case, what they're going to do is you can spread that out over 3 years, meaning that tax hit. So that could be a good plan for some of those if you have a hardship situation as it pertains to this health situation. Next up, non-retirement accounts, okay? Look to take some profits. What do I mean by that, right? This year has been a good year, especially the second half. So maybe you've got some profits. Now, here are the tax brackets for this year. This is another reason you might consider doing it now, okay? We know with the new administration, taxes are going to go up, especially as it pertains to long-term, short-term capital gains, etc. All right? We know that. Don't know when, don't know the final numbers, so it's a good time to lock in those gains now at these lower rates. Here's your chart here. You can figure that out. Talk to your advisor. This is something we obviously do and work with your accountant. Make sure it makes sense. Now, at the same time, you might have an opportunity to harvest some tax losses, right? Back in March, when things were selling, we're trying to raise cash, protect portfolios, maybe you've got some losses in that time. So let's go through a quick scenario. You buy a stock at $50, $100 a share, $5,000. Pretty simple, right? You've got your profits of $3,000. Maybe you have another stock, $50 a share, 100 shares, $5,000. Missing a zero there, sorry. Current price is 30, so you've got a loss. So, from a tax standpoint, you might be able to offset those gains with those losses. Again, speak with your tax professional on that. We work with, for clients who have non-retirement accounts, we'll work with their accountants. We'll also work with the clients to see what their threshold is on taking taxable hits during the year. So good thing to look at as you head into the end of the year. Student loan required payment suspended, okay? Obviously, this helps those students, okay, who are paying back because who knows what's going on right now. But also part of that, we want accruing interest. Now, if you're still working, okay, I highly recommend making some of those payments this year because you'll be knocking down just principal, just like your mortgage, right? So again, if you're working, if you still have the means, why not make those payments, even more payments, because you're able to knock down that principal, can really help you in the long term. Last but not least is going to be year-end gifting strategies, okay? Remember, if you're in this position, you could do $15,000 per. What do I mean by that? Kids, kid spouses, grandkids. So if you've got a decent sized estate, a great time to plan on that. There's some other strategies where someone might gift to a child. They then go ahead and pay for the insurance on an insurance policy. A little more creative. Estate planning, not going to get into that here, but there's a lot of different things that you can do. You can also make unlimited direct medical and tuition expenses for this year. So, there you go. Some good tips today. Hopefully you got some value from that. If you did, make sure you do subscribe and like. Couple planning tips. Be smart. It's not just what you make, it's what you preserve in taxes. So let's take advantage of these. Thanks for watching. Michael Loftus, Wealth and Wisdom TV.